that's the case, yes, you are more likely to be audited and 15 times more likely to be audited as a Schedule C.
Wrong. Don't do that. Hi, I'm Nate. I'm the founder of Cookie Finance. We are an accounting platform specifically for content creators. I've been a CPA for over 12 years, and today I'm going to react to TikTok videos on taxes, and this is our part 2, so let's see how this goes.
This is why savvy business owners set up their LLCs in Wyoming. Number 1, it's very cheap to start. It only costs $100 to file your articles of organization. Number 2, low annual fees, just $50 a year.
Okay, so I'm with him so far. It's cheap, low annual fees, but most states it's pretty cheap and low annual fees in most states. Once again, maybe you're saving like $100 a year by being in Wyoming. It's not a great argument, but I can almost guarantee you I know where he's going with this.
Number 3, no business or franchise taxes. All the more money for you. Imagine all the things you could do with those savings.
Okay, so once again, it is true. There is no business or franchise tax. Now, most states don't have a business or franchise tax. Majority of the states don't have that tax. Very few do. Once again, Tennessee is a really big exception to that, but most states don't have a franchise tax. So you're not really saving money in taxes. Now, when you set up an LLC in Wyoming, you might be taking on more risk than if you're set up in your home state. And here's why. The whole point of an LLC is that liability protection. Let's say that I'm living in California, I'm creating content here, this is where my home office is, and my LLC is in Wyoming. Well, my business is operating out of California and I get sued. Technically, I don't have any protection because I'm operating out of a state where I don't have an LLC because my LLC is over here in Wyoming. So technically, there is a big risk that if you got sued, they could still come after your personal assets because your LLC is not registered in California. Now, you could set up an LLC in Wyoming and then a foreign LLC in California, but that gets way too complicated and there's really no reason to do that. In fact, if you look up, Apple has an LLC in every single state because they operate in every single state. So you need to be registered in the state you're working in. Otherwise, you lose that liability protection, which is one of the fundamental things of why you have an LLC.
As we all know, that our U.S. tax system is a voluntary tax system, and we depend on people willing every year to sit down, fill out that form, and pay their appropriate amount of taxes.
So I already know where this video is going to go from. It is true that the tax system is a voluntary. It doesn't mean that, you are just giving taxes out of the goodwill of your heart. What voluntary means is that no one is filling out the tax form for you. So you have to go fill out the taxes and you report the income to the IRS. Now, payment, everything else, like that is mandatory. You are required to file a tax return, but it's voluntary from a standpoint of you have to do it yourself. The IRS isn't doing it on your behalf. No one else is doing it on your behalf. And so what this IRS director is saying is that we need more money to the IRS to enforce those people who are not voluntarily filing. But I already know where this video is going, but let's see what he has to say.
Okay, so I want to explain this. How could taxation be voluntary for some and mandatory for others? Allow me to explain. As we can see here, right here in the tax return forms and instructions, it clearly states that the tax system is based on voluntary compliance. What does that mean?
I've seen a number of these videos, and what you're going to hear is that, taxes are voluntary, that you can structure your income as not as a treasury note, but as a sovereign, whatever. And it's that one trick the IRS doesn't want you to know about. And it's not true. There's going to be some weird tax code I'm sure he's going to reference. I already know where he's going with it. And I already know it's bad advice. And the IRS has already put something out on their website saying do not listen to this advice because it is completely wrong. It's fraudulent. And you are going to be liable for taxes. But let's just see what he has to say.
Overwhelmed with information, but there's no such thing as an income tax, really. Everything you pay to the IRS is considered as a gift or bequest to or for the use of the United States. And if you dive deep into the law, you'll see that this is printed over and over and over and over because they have to properly disclose that everything you think you pay an income tax is a gift or bequest, and a gift does not need to be returned.
Okay, I knew this is where this guy was going from. What he's saying that is if your income is structured as a gift, then you don't need to pay taxes on it, because you only pay taxes if it's deemed a treasury note and whatever. I know where he's going with that. I don't even want to go down this rabbit hole because it's just completely wrong. No, you cannot structure all of this as a gift or as non-treasury, whatever. You can try, but I can guarantee you it's going to throw up so many red flags. You are going to get audited, and then you're going to pay taxes anyway, and then you're like in the crosshairs of the IRS. So once again, don't take advice from TikTok. I give this one like a 0 out of 10, not even like a 1 out of 10. This is just terrible, terrible advice. I've seen this on the IRS website. They specifically call out this tactic as fraudulent. If they're calling it out as fraudulent, that means if you do it, you are committing fraud, and that's not good. So do not listen to this. Do not declare your income as a gift, and don't pay taxes on it, or it says sovereign whatever, and it's not a treasury whatever nonsense. Like, wrong. Don't do that.
3 tax write-offs you can take as a social media manager, content creator, or influencer. Any clothing that you wear on camera or anything to make you look better, your hair, your lashes, whatever, write off.
So yeah, clothing and those type of personal items can be potentially deductible. It's not 100% write-off. If that clothing is essential for that shoot, it's part of a content, then you can write it off. Or if you're an affiliate marketer with Amazon and you're buying clothing, have affiliate links associated with it, then you can write it off. It has very specific purposes that you can then write it off.
Since you're using your phone to do your entire business, write off that phone bill.
Yeah, absolutely. Your phone, that's essential. So make sure that you're writing off your phone. If you split your phone with your spouse, you can always take a portion of it, take half of it. Or if you're part of a family plan and you Venmo your mom every single month for your phone, you can write off that portion that you're Venmoing your mom. You can definitely write off your phone. That's great advice.
I'm recording in my house. I can write off a portion of my rent.
Yep, portion of your rent. That's exactly right. So the portion that is your home office, you can write that off. So overall, great advice. Just once again, be careful with that first part, that you're not just writing off every single personal. But overall, this is good. 8 out of 10. She did a great job giving those deductions.
You are 15 times more likely to be audited if you are just operating as an LLC. Now, that may shock you, but let me explain why. If you are an operational business, landscaper, plumber, electrician, you're selling online, and you're just an LLC, that means you're reporting as a Schedule C or a single member LLC or a disregarded LLC. When that's the case, yes, you are more likely to be audited, and 15 times more likely to be audited as a Schedule C.
So I would actually like to see where he got that 15 times more likely to be audited as an LLC. I'm curious to see where he's trying to go with that, but you're not 15 times more likely to be audited as an LLC. Now, if you are a business owner in general, you are more likely to be audited, but I don't know where he got the 15 times more likely to be if you're an LLC. Just inherently, if you're a business owner, you're making more money, there's deductions you're taking, you're interpreting the tax law, you are going to be more likely to be audited no matter what type of entity you are. An LLC, an S Corp, a partnership, a C Corp, there's a higher chance that you get audited, but it doesn't mean that you're 15 times more likely if you're an LLC compared to anything else. That's just wrong. In general, the likelihood that you get audited is about 1%. IRS reports those stats. You can look them up. It's anywhere between 1.5%, depending on your tax bracket. But once again, I don't know where he got that 15 times more likely if you're set up as an LLC. I think I know where he's going, but let's see.
So what's the solution? You move to the S Corporation. When you take your LLC and tax it as an S Corporation, you're still an LLC, but you're taxed as an S Corporation.
So that is very true. And this is where people get confused. They say, oh, should I be an S Corp or an LLC? As an S Corp, you are always an LLC. So he got that 100% correct. I'm really glad he made that distinction. A lot of people get confused. This one, he was very clear. He did a great job on that part.
Now, your chances of an audit went down by 15 times, and you're also going to be saving on self-employment tax.
Okay, so it's true. S Corp, the big benefit of being an S Corp is you do save money in self-employment taxes. It has to do with payroll and self-employment taxes. So that is great advice. If you are making more than $125,000 a year, it usually makes sense to become an S Corp to save money in those self-employment taxes. I will give this one a 6 out of 10. It was correct information. I just don't know where he got that 15 times number from.
For Valentine's Day, I thought I'd buy a gun.
Yep. So this is like one of the sneakiest tax that you have as a self-employed person, a content creator, an entrepreneur, is the dreaded self-employment tax. So self-employment tax is Social Security and Medicare. When you are an employee at a company, you have a W-2, out of every paycheck, they take 7.65%, and they give that to the Social Security and Medicare. So when you retire, you can collect your Social Security benefits. So it's 7.65% out of every single paycheck is getting paid out to that. You'll see that on your pay stub, Social Security and Medicare. What most people don't realize is that the employer is also paying 7.65% as well. So guess what? When you are self-employed, you're both the employee and you are the employer. So you pay both halves of that 7.65%, which comes out to 15.3%. Now, a portion of that is deductible, but not nearly enough to like make up for the huge increase in taxes you have to pay. So unfortunately, that's like the biggest downfall of being self-employed, being a content creator, is that self-employment tax. It's hard to avoid, but if you do set yourself up as an S Corp, once you're making more than, call it $100,000 a year, you can avoid paying a portion of those self-employment taxes. But definitely make sure you're planning for it. It's a sneaky tax. Most people aren't ready for it. And it's like a knife to the heart when you see that first tax bill and you see how much it is for, because you probably weren't mentally prepared for it, because they don't teach you this stuff in school, unfortunately. Moral of the story is, don't get your tax advice from TikTok. Consult with a tax professional who knows what they're doing, especially a professional who understands content creators, because there can be two different CPAs. One works with creators and one that doesn't, and they can give you wildly different deductions and advice. It's important to work with someone who actually understands content creators. So make sure that when you're vetting your CPA or your tax professional or your tax preparer, make sure that they actually understand content creators, so you get every deduction that you really deserve.
Tax, bookkeeping, and accounting services exclusively for content creators and influencers. That's Cookie Finance.